Welcome to Trader TV Equities, your insight into the trading climate for professional equity investors. I'm Dan Barnes. In August show, we're talking with Mark Denny, Head of Trading for Global Equities at Investec Asset Management, about trading of emerging market stocks in recent months. Mark, welcome to Trader TV.
Thanks, Dan. It's great to be here.
So I'd like to start by asking you, what sort of activity have you seen in emerging markets over the last quarter?
Clearly from an EM perspective, we've had one or two bumps in the road, Russia not least, Turkey more recently perhaps. So I think looking back to the beginning of the last quarter, a fairly smooth ride, but now starting to become a little bit more rocky. I think that headwind's going to continue now.
When you're trying to manage the costs of trading and the value that the trading desk provides, how is that impacted trading EM versus DM?
Certainly from an explicit cost perspective, in other words, brokerage fees, the emerging markets are a little bit more expensive than trading the developed markets. I think there's two things there. The reasons for that, I think two key reasons, is that the emerging markets are less developed with regards to direct electronic trading, where trading is obviously more efficient and potentially cheaper. There are a lot of emerging markets now that have actually opened up their doors to electronic trading. So that is a trend that's improving. But also access to the emerging markets. Often, investors may not have direct access to the exchange or local counterparties, so they're perhaps engaging with an investment bank who then introduces a chain of access into that market, and that starts to make the costs of actual final execution, relatively high. So you're paying the investment bank, you're then paying another local broker, and then you could be paying a second local broker potentially as well within that equation. So, but that I think, to be honest, I think that's starting to become more efficient now. Certainly from our perspective, one of the key things in order to keep these costs under control, obviously as well as the explicit costs, you've got implicit costs as well. In other words, your footprint in the market or your market impact. Yeah. So in order to try and minimize both of those scenarios, we've developed relationships with local counterparties and there are now more local counterparties who we feel confident with trading and investing for our clients through. So kind of missing out one or two parts of the chain perhaps. And also engaging on electronic trading where we can, but I think that's probably relatively still primitive, but still improving.
So that's very interesting. So you have the two parts. One is the ensuring that you're engaging with electronic trading where that is possible, but also very much developing those relationships as the trading desk, and this is of course why you need an explicit trading function, so that you can work out where liquidity is, where to find the best pricing information.
Emerging markets, of course, don't have anything like the kind of fragmented liquidity sources like we do in the US and in European markets, where you have multiple trading venues in order to access. But even those access to those venues in the US and Europe is obviously very efficient electronically these days, so you can actually access multi-venues quite easily. The thing, obviously, with the from an EM perspective, there's nothing like that kind of fragmentation that we see in the Europe and US. So, the majority of liquidity that you will access will be on the primary exchange. Particularly across sort of LATAM and the Asian markets. So, in order to minimize impact or footprint in those markets, if you are introducing a sort of multi-chain access to your final destination, your kind of noise and your footprint in the market is potentially, and your information leakage is potentially increasing as you go through each of those stages. So one of the key things is to access directly to where you can to a local counterparty. And having chatted to my trader in Asia on some of the Asia EM markets, what he was saying was, the brokers that have access to these markets have very, very good knowledge around the holders of the securities that, and often the securities are held quite tightly, not across multi-institutions. So in order to get to your final destination of perhaps sourcing natural liquidity, i.e. hiring a broker to talk to a client who they know owns the security, it's arguably more of an efficient process, because you actually are keeping your kind of market leakage to a minimum, because you're actually accessing liquidity quite efficiently.
So Mark, what are your expectations for emerging markets over the next 12 months?
Dan, certainly from a trading perspective, we do expect to be engaging more on or improving our electronic trading access into the liquidity venues across emerging markets. So that's something that will hopefully make us a little bit more efficient in accessing those markets, and hopefully start to bring trading costs, explicit trading costs down a little bit. I think from an environmental perspective, it's quite clear right now. There's a little bit of headwind as we're moving forward, as I'm speaking to you now, not only from a US perspective. There obviously we have, quite easily get caught out with Russian sanctions, for example, and all of the activity that's going on around trade negotiations. Markets have obviously induced a little bit more volatility just over these last few weeks. It feels like things, as I say, in the slightly short term, settled a little bit, but I think we're probably going to move into a little bit more volatility, perhaps.
Mark, thank you very much.
Pleasure. Thank you, Dan.
I'd like to thank Mark Denny of Investec Asset Management for his insights into trading emerging markets, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.net.